Hi, I'm Noah Solomon, Chief Investment Officer of Outcome Metric Asset Management, and today I'm going to discuss why mitigating volatility is crucial to improving your long-term returns. So today I'd like to address what I think is one of the most common pitfalls of investing. Learning how to avoid this pitfall will help you make better decisions and achieve better results in your investing over the long term. So in most areas of our lives, we employ a basic logic or principle. And that basic principle is to try and get the most and pay the least. And yet, this same basic principle that we use in all our other financial decisions, many people abandon when it comes to their investment decisions or their portfolios. So with investing, when you hire an investment manager, you get returns, but what do you pay? Yes, you pay fees, but that's only one part of what you pay, and arguably the smaller one. What you really pay is risk. In investing, your overarching goal should be to get the highest returns possible by taking the least amount of risk. Many people look at one side, they only look at the returns they're achieving without having an understanding of the risk they're taking to achieve those returns. That's like signing an agreement to buy a car without knowing the price. It's like giving the salesperson a blank check. Now, there's always some chance that this will work out fine, but I certainly wouldn't advise going about things that way. Shibuya Crossing in Tokyo is the busiest intersection in the world. Now imagine there's two pedestrians waiting at a light at Shibuya Crossing. The first person is in a hurry. He's in a real hurry and he crosses against the light. He crosses on a red. The second person is in no hurry and she's happy to wait. Let's say in the first person's case, crossing on a red, he runs a 25% chance of getting hit by a car. So he crosses the road and in fact he does not get hit by a car. He succeeds and he saves himself a minute or two. Great. But the fact of the matter is this. If he constantly takes this risk, he took a risk and got lucky. But if he constantly does this, if he crosses on a red 100 times or 1,000 times, sooner or later, it's only a matter of time, he's going to get hit by a car. So imagine I told you I have an investment for you and you can double your money in a year. And that's all I said. I stopped there. You'd probably say, that's great. Tell me where to sign. I'm ready. But then I said, but you could also lose all your money. Then you'd say, well, wait a minute, you wouldn't be so sure. So you need to assess an investment manager, not just in terms of the returns they're achieving, but also in terms of how much risk they're taking on to achieve those returns. If a wealth manager gets double the returns of the market, but they also take double the risk of the market to get there, then they haven't added any value. They've gotten twice the good thing, returns, but they've had to take on twice the bad thing to get there. That's like taking a dime out of one of your pockets, putting it back in the other pocket, and then doing a victory dance for the privilege. In good times, when markets have been on a tear, there are always some managers that blow the lights out, that don't only do as well as a good market, but much better. However, in many cases, those amazing blow the lights out returns are not due to skill. They're due to risk. It's risk masking as skill. And then of course, in those cases, when markets take a turn for the worse, which they eventually always do sooner or later, it's, as I say, it's always a question of when, not if, these managers can suffer losses that are much more severe than the market. So imagine it's late 1999, the height of the tech bubble, and markets have been on an awesome tear, and everyone thinks it's easy to make great returns. Now imagine in late 99, you invested in the Van Wagoner Emerging Growth Fund. So had you invested $10,000 at the beginning of 1997 in that fund, by March of 2000 at the peak of the tech bubble, it would be worth $45,000, a 450% return. So what did people do? They thought it was skill. They just looked at the returns without any assessment of the risk inherent in that fund. So they piled in. In 1999 alone, assets under management for the Van Wagoner Emerging Growth Fund went from $150 million to $1.5 billion in 1 year. People were only looking at the return without regard for the risk. But then, when markets turned south, it lost 20% in 2000, 60% in 2001, and 65% in 2002, or at least by mid-2002, at the bottom of the market. So that $10,000 that you might have invested at the beginning of 1997, which was worth $45,000 at the peak of the bubble in March of 2000, dwindled by mid-2002 to $3,300. You went from a gain of 450% to a loss of over 65%. In other words, the stellar performance in the good times of the Van Wagoner Fund, which people thought was skill, they just looked at the return, was not skill. It was risk masking as skill, which became apparent when markets turned south and it suffered far worse losses than the market. Warren Buffett likes to say, it's only when the tide goes out that you get to find out who's been swimming naked. It's clear that in Van Wagoner's case, when the tide went out and markets went south, their nether regions were on full display. I'm always suspicious of a manager or strategy that has great numbers in a bull market with not enough track record to see how they have performed in a bear market. To properly evaluate a manager's skill, you need to understand how much risk they're taking. You need to understand not just how they behave in a good market or a bull market, but also how they behave in a bear market. And only then, when you're looking at both return and risk, can you truly evaluate the skill of the manager, which in turn will enable you to make better decisions and achieve better results over the long term. Back to Buffett. At Outcome, we don't swim naked. Our data-driven, machine learning-based models directed us to de-risk and protect our clients from large losses, both during the horrible fourth quarter of 2018 and during the tumultuous March of 2020. We believe that our approach will continue to generate profits during the good times while protecting them from large losses during the bad times. Thanks for watching. If you want to learn more about outcome metric asset management and our investment strategies, please visit our website at outcomewm.com, where you can receive our contact information and sign up for our monthly newsletter.